Taxes. They're unavoidable, but what if I told you there are perfectly legal, smart ways to reduce your tax bill significantly, all through strategic investing? Welcome to our beginner's guide on how to legally reduce your taxes using smart investments. This 8-minute video will outline actionable strategies to save you thousands. First, let's address some common misconceptions. Tax reduction isn't about shady loopholes. It's about utilizing government-approved accounts and investment vehicles designed specifically to incentivize savings and investment. These strategies can benefit almost anyone, regardless of your income level, but they are particularly powerful for those in peak earning years and those planning for retirement. Before we proceed, a crucial disclaimer: I am not a tax professional. Always consult a certified tax professional or financial advisor for personalized advice based on your specific financial situation. Smart investments are the engine of legal tax reduction. By placing your money in the right accounts, you can drastically minimize current taxes, defer taxes, or even eliminate them entirely. Consider this real-world example. Investor A invests $6,000 annually in a taxable brokerage account, while Investor B uses a tax-advantaged account like a 401k. The difference in net returns after taxes over 20 years is staggering. The true magic happens with compounding. When you save on taxes today, that money is immediately invested and begins earning returns, growing exponentially over 10, 20, or even 30 years. We'll focus on 3 major strategies for legal tax reduction: using tax-advantaged retirement accounts, leveraging health savings accounts, and employing tax loss harvesting. Strategy number 1, tax-advantaged retirement accounts. These are foundational to long-term tax reduction and wealth building. Traditional IRA and 401k accounts allow for pre-tax contributions. This means the money you contribute is deducted from your taxable income immediately, offering an upfront tax break. Conversely, the Roth IRA and Roth 401k use after-tax contributions. The massive benefit here is that all growth and subsequent qualified withdrawals in retirement are completely tax-free. The key difference is when you take the tax hit, now with Roth or later with traditional. Be sure to check the yearly contribution limits, as they can change and have income phase-outs. Let's calculate. A $10,000 contribution to a traditional 401k for someone in the 24% tax bracket saves them $2,400 immediately. That's money that stays in your pocket today. A common mistake is choosing based on current income without projecting future income. If you expect to be in a higher tax bracket in retirement, Roth is usually the superior choice. Strategy number 2 is the Health Savings Account, or HSA. Often overlooked, the HSA is arguably the most powerful tax-advantaged account available. Don't just use your HSA for current medical expenses. Maximize its potential by treating it as an investment vehicle. Many providers offer investment options once your balance exceeds a certain threshold. Once you turn 65, the HSA behaves like a traditional 401k. You can withdraw funds for any purpose without penalty, only paying income tax, making it a fantastic supplemental retirement account. The HSA is famous for its triple tax advantage. Contributions are tax-deductible, growth is tax-free, and withdrawals for qualified medical expenses are also tax-free. To open and contribute to an HSA, you must be enrolled in a high-deductible health plan, or HDHP. Make sure your insurance plan meets the IRS requirements. When selecting an HDHP, compare the premium savings against the potential out-of-pocket maximums. Look for a balance that minimizes monthly costs while still offering a reasonable safety net. The IRS sets limits on how much you can contribute annually to an HSA. Additionally, if you are 55 or older, you can take advantage of catch-up contributions, allowing you to save even more pre-tax money. Our third strategy moves into brokerage accounts, tax loss harvesting. This is a crucial technique for anyone with taxable investments. Tax loss harvesting involves selling investments that have lost value to offset capital gains realized from selling profitable investments, effectively reducing your tax liability. A critical rule to avoid is the wash sale. You cannot sell a security for a loss and then buy a, quote, substantially identical one 30 days before or after the sale, or the loss deduction will be disallowed. To execute harvesting, identify a loser, sell it, and immediately buy a non-substantially identical fund or security to maintain market exposure, then wait 31 days. Tax loss harvesting is generally easier with ETFs than mutual funds, as ETFs often provide more options for buying a similar but not identical investment to avoid the wash sale rule. Now for a bonus strategy, particularly useful for high-income investors: municipal bonds, or munis. Munis typically have a lower yield than taxable bonds, but once you factor in the tax savings, the effective yield often surpasses taxable options, especially for those in higher tax brackets. To maximize savings, look for municipal bonds issued within your state, as they can also be exempt from state and local income taxes, offering a powerful triple tax exemption. While safe, munis are not without risk. Be aware of credit risk and interest rate risk. Always ensure the bond quality is high before investing. The primary benefit of munis is that the interest you earn is exempt from federal income tax. This makes a significant difference in your bottom line. Because the tax savings are most valuable at higher tax rates, munis are generally recommended as a core fixed income holding for high-income earners. More bonus strategies: consider charitable contributions and donor-advised funds. Donating appreciated assets can provide a deduction without realizing capital gains. For education savings, the 529 plan offers tax-deferred growth and tax-free withdrawals when used for qualified educational expenses, making it an excellent vehicle for college savings. Real estate investments offer substantial tax advantages, including depreciation deductions, which can offset rental income, and 1031 exchanges to defer capital gains upon sale, though these are more complex. We've covered a lot of powerful strategies. Remember, the sooner you start, the more time compounding has to work its magic. To recap, focus on maximizing your retirement accounts, leverage the triple tax advantage of HSAs, and implement tax loss harvesting in your taxable brokerage accounts. Your personalized action plan should begin with assessing your tax bracket and then determining which account, Roth or traditional, is most advantageous for your future self. Avoid these pitfalls. Don't miss contribution deadlines, don't ignore the wash sale rule, and ensure you qualify for an HDHP before contributing to an HSA. Your next step should be taking action. If these strategies seem complex, remember our initial advice. Contact a qualified financial advisor or tax professional to help you implement the plan that's right for you.